suddenly struggle to generate cash, their debt piles up, and their stock price falls much harder than the rest of the market. A perfect example of this is Yes Bank. Before its collapse, the bank reported steady earnings growth. On the surface, everything looked great: rising net income, expanding loan book, strong investor interest. But there was one problem. The bank was recognizing interest income from loans that were already turning bad. It was showing profits on paper, but in reality, its cash flow was drying up. When the bad loans finally came to light, the stock collapsed from over 400 rupees per share to single digits, wiping out investor wealth completely. Another example is DHFL. For years, DHFL reported high profits and grew aggressively in the housing finance space. But behind the scenes, it was using aggressive revenue recognition, hiding bad loans, and manipulating financials. Investors ignored the warning signs, and weak cash flows, high accruals, and questionable loans. And when these problems surfaced, DHFL went bankrupt, and investors lost almost everything. This isn't just limited to banking and finance. Look at Reliance Communications, part of the ADAG group. The company reported strong earnings on paper, but these profits weren't backed by any actual cash. Most of the earnings were coming from highly leveraged operations, deferred expenses, and aggressive accounting practices. The moment debt became unsustainable, the business collapsed. Even in the airline industry, Jet Airways followed the same pattern. It kept expanding aggressively, and for years it reported strong revenue growth. But behind the scenes, the company was struggling with high debt and poor cash flows. The business was running on borrowed money, and when conditions worsened, Jet Airways collapsed, leaving investors and employees stranded. Now, how to spot companies with high quality earnings? The easiest way to check a company's earnings quality is by comparing cash flow from operations to net income. A strong business should generate real cash alongside profits. If net income is rising but cash flow is declining, then that's a red flag. A perfect example of this was Syntex Industries. Once a well known textile and plastics company, Syntex kept reporting high earnings, but its cash flows were weak. It took on excessive debt and used financial engineering to make profits look stable. Investors focused only on net income didn't see the warning signs. When the crisis hit, Syntex defaulted and the stock became worthless. Another way companies manipulate earnings is through one time gains. Some companies show a sudden jump in profits, but when you check deeper, the increase is not from operations, it's from selling an asset or receiving a government incentive or settling a legal case. Vedanta, for example, reported strong profits in certain years, but a large part of it actually came from selling stakes in Hindustan Zinc. That is not a sustainable source of revenue. The same thing happened with Suzlon Energy. At one point, Suzlon was one of the biggest names in renewable energy, reporting massive earnings growth. But much of that profitability came from one time gains, debt fueled expansion, and aggressive depreciation policies. When conditions changed, the company could not sustain itself and the stock crashed from over 400 rupees to nearly zero. If you want to